Gosh, 20.
Okay.
Okay, yeah, there you go. Go ahead. Perfect. So yeah, so Eric and I, we have a combined experience of over 28 years of financial experience. So I came from the traditional Wall Street world. I was a stockbroker, did advanced derivatives trading. So all of this that we are going to present, this is actually, just kind of keep this in your mind. This is coming from, me personally, a guy that used to poo-poo these.
Oh, we lost him. So David is unfortunately having to travel last minute today. Oh, there he comes. He's back.
Market and everything's going to be fine. Well, I think you guys know that that's we come to find that that's not really how that all works out. So um, Eric and I both left these big box firms. Speaking for Erica, she came from a retirement planning world, so kind of an income a retirement plan. So together we really do have a plethora of financial knowledge when it comes to all things just kind of finance. But because of the inconsistencies in that traditional world, we both left that world, got together at a boutique firm that we were doing, basically our own kind of full planning for people. We were both doing real estate, and we were actually utilizing this strategy where we were leveraging these policies for as a banking system. And so we got together and we said, you know what, let's actually focus on just teaching the infinite banking strategy. And because we've done real estate, we've done, I have multiple short-term rentals. We are both active syndicators on the multifamily side. We have done new single-family developments together. So we have a wide array of real estate knowledge as well. So we said, let's create a firm.
All right. So he may be going in and out. I hate to interrupt him. So like you
Actually,
oh, there you go.
so we are both, there we go. Infinite banking practitioners through Nelson Ashford. So we'll dive into that a little bit further as we go along. But just banking, if you think about this, banking is the most profitable business in the world. So how do we emulate what bankers do? So as Erica said, she's going to take over and run this first meeting. And then the second meeting, I will come in and dive a little bit further. So we will get to some numbers. So just bear with us. And like Erica said, if you have questions, hold off to the end, and we'd love to answer those for you and give you a little bit more clarity before we finish up for the second meeting. So thank you, Erica. We'll go.
All right. Thank you, David, so much. So like you said, yeah, we will get into the presentation. We are Infinity Investment Strategies. All right. So on this, when we talk about infinite banking and when we're beginning to educate people about this, and I will say mine and David, we got one more coming in. So mine and David's biggest area of focus when we're talking about infinite banking is the education on the strategy. Okay. And we say that because this is not a get rich quick scheme. This is not something where we're going to chase rate of return. Infinite banking in and of itself, it is a concept and it is a strategy around wealth building and being tax efficient and protecting assets. Okay. So we're going to hone in on all of those today, but just know, again, David and I come from the traditional investment world. We've done the whole chasing rate of return and trying to outperform the market and all of those wonderful things. We've been there, done that, got the t-shirt. But really, we have repositioned ourselves to focus on, instead of looking at the rate of interest that we're earning, what we're doing is we're saying, hey, it really doesn't matter how much we earn. What matters is how much we keep. And that's not to say that rate of interest is not important, but understanding the volume of interest, meaning how much of the money that we have and the interest that we're earning, the cash flow that we have, how much of that is coming back into our own account and staying within our own compound interest curve so we can maintain compound interest indefinitely, right? So when we talk about IBC, again, David and I come from this investment world where we poo-pooed these whole life policies and all of that. But at the end of the day, when they are structured correctly, they can be very powerful, that we're going to look at today. But we'll go ahead and move on. David really We will say we're not going to go through this. Obviously, we have quite a few people on this call, but one big thing that we want to make sure we emphasize is each person is different. Every single person on this call has a different scenario, has a different background, has a different goal. So one of the biggest pieces of our process is to make sure that we go through a diagnostic process with each person to understand who are you? What are you looking to do? What are your goals, short-term and long-term? And what type of legacy is really going to put you in a position where you feel relieved and you feel like you've done your job? So again, this is a very tailored aspect. Everybody's different. So that's where David and I come in and we start to critique and let me see, Mary's in. We start to hone in on specialize and creating a tailored policy, a tailored tool specifically for you. And again, one of the big things I want to emphasize on this, and David mentioned it, is we are authorized infinite banking practitioners. So all of that to say, anybody that's doing infinite banking, anybody that is doing this needs to work with an authorized practitioner. Bottom line, that's not to say that other financial advisors or other, people out there don't know, they don't have their own specialty. But I always tell people, if you have a foot problem, don't go to a cardiologist. Right? Like go to somebody who specializes in that field. And David and I are specialists. We are real estate investors, but one thing I wanted to point out is we are on an independent platform. So that means we have the ability to go out, shop the market, and we help people figure out which company is going to offer them the best tool for the job. And one of the analogies you'll hear us say over and over again is there is no such thing as a good tool or a bad tool. There are just tools designed for certain jobs. So we can't get mad at a hammer when we try to cut a piece of wood in half. Right? Like that's not what it's for. So again, we are independent. We really oftentimes will pit companies up against one another just to make them compete for our clients' business. Because obviously we specialize in this field, we carry a lot of weight, but we want to make sure that our clients are getting the best possible offer. Now, when we talk about infinite banking and bank on yourself, be your own banker, right? It's all these different catchphrases that are used. The root of this is banking. And when we look at it, we have to understand, well, why do we want to become a bank so badly? And if we understand how banks make money, then that really helps us understand why we want to recreate the same system that banks have. So how banks work, if you guys aren't familiar, let's say that you come to me and I'm your banker, all right? And you deposit money with me, I might pay you 0.02%, right? In like a high yield savings account. Now, on the back end though, what happens is David comes in to get a loan. I'm a bank, I give him a loan, but wait a minute, I'm a bank, I don't have any money. So whose money do I loan to David? Yours. I'm using your money, I'm going to pay you 0.02%, turn around and loan it to David at 6. So from a high level, most people see this transaction and think, oh, well, the bank's return, they earned 6 and they paid 0.02, so they earned 5.98, right? Well, here's where we start to have the mind shift. And I will tell y'all, one of the biggest pieces that we tell people is there is a difference between money and math. And if we can't have that mind shift of looking at these things through the lens of money and strategy, sometimes people do, sometimes people don't. But if we can't have this mind shift, then this is the barrier to entry is understanding how money and math are so different. So in this example, this 5.98 is only the spread. That does not tell us what the actual rate of return is. So let's look at this like an investment transaction. If you were to invest 2 pennies in anything, because that's what's happening, for every $100 that you give to the bank, they pay you 2 pennies. But when they loan out that $100, when I loaned it to David, I'm making 6 off of that. And this is just the most simple way to put it. In any other transaction, any other investment, if you invested 2 pennies in something and at the end of the year it was worth 6, that rate of return would be a 300x. You are getting a multiplier of 300 on your dollars. The banks are getting a multiplier of $300 on your dollars, because they understand the power of this little thing that we call arbitrage. They're paying a little to turn around and earn a lot. So when we're looking at this, the big thing to understand is, whoa, why, if banks are making a 300x return, why have we had to bail them out twice in the last decade? Right? Like that's just a personal opinion, but not to demonize banks, but this is just saying, instead of keeping all of our money in the bank and letting them rinse and repeat this process, because this doesn't even take into consideration fractional reserve banking. But why give them all of our dollars? Because this is what they're going to do. Why don't we take our dollars, bring it back into our own account that we can create this same system and we can start making money on our own money instead of allowing them to do all of that. Okay. Now, again, this is not saying that banks are bad. There is no good tool. There's no bad tool. There's just tools for certain jobs. So when we have people and when we're working with people, I will say again, because David and I come from the traditional investment world, that is very much a my daddy can beat up your daddy type space, right? Like if you put money with that guy, they suck and they're awful and everybody else is terrible other than me. And here's the bottom line. That is not true. We need to understand, again, different accounts, different purposes, and understand what we're trying to accomplish with our money. And that's going to help us to be efficient and effective with the way that we save. Now, in this savings dilemma, what we have to understand is there's three functions of our money. We have short-term needs, intermediate term needs, and long-term needs. Okay. So short-term, obviously that's pretty self-explanatory. That's a bank. And when we look at it, we think, well, why do most people put money into their bank account? Well, typically they consider it to be safe, right? I always put that in quotations because, you know, that's relative. But it's also liquid. Okay. Again, that could be quotations, but the idea is we can use this for day-to-day transactions. The trade-off to this is we're not really earning anything as far as interest in these accounts. So this is something where we need to use the dollars within the next 0 to 12 months or we're losing money due to inflation. All right. Now let's look at the long term. On the long-term side for the investments, this is a broad category. Okay. This can be real estate portfolios. This can be businesses. This can be your stock portfolio, your 401k, whatever. Something that over the long term, we are hoping to see some level of growth and return in this account. Now, the catch is with an investment, we know that it's not safe. All investments carry risk. We also know money inside of an investment is not typically liquid. We cannot immediately access that. So these are funds that we know we need to be ready to put these on the back burner for 7 or more years before that's going to come to fruition. All right. Here's the problem. And this is where we talk about the savings dilemma, because most people are like, well, I feel pigeonholed. If I want safety and liquidity, I have to sacrifice growth. If I want growth, I have to sacrifice safety and liquidity. So I can put my money in an account where I need to use it within the next year or lock it up for 7+. That's a massive gap. Most people have a huge hole here in their overall plan, specifically business owners and real estate investors, because they need a place to hold money on the intermediate term, but fill in all the gaps that aren't being addressed. What about money that I want to be able to use today? I want to be able to use it right now, but I also want it to benefit me in another 20 or more years. Okay. So when I say we're going to fill in all the gaps, this is what I'm saying. We're going to give ourselves guaranteed growth, much more than what we're getting in a bank. The money is safe, meaning it will never go down in value. It will never decrease. It's also liquid. I can have access to this money within, I'll have it in my account within 24, 48 hours, right? Boom, quick, no questions asked. Now let's throw in some tax benefits, right? So tax-free, and oh yeah, it's private and protected from creditors and predators. Yes, I'm going to hone in on that here in a minute because some ears perked up. So when we look at this, all of these characteristics, if we notice this term, the vault up here, good old Warren Buffett, right? Granddaddy Buffett is the one who actually coined that term when referring to these types of policies. So think about it. Think about a vault in your garage or basement or whatever. You can put money in when you want. You can take money out when you want. And who knows how much cash you have sitting in your vault at home? Just you, right? Nobody else's business. It's safe and protected and it's easily accessible. So again, when we're talking about this, all of these need to be assets that we have in our overall financial picture. These are designed to work together. It's like having a hammer, a saw, and a screwdriver in your toolbox all working together. So the question is, well, wait a minute, how does this integrate? Great question. So what we would see in this cash flow scenario would be, all right, we're going to take money out of our bank account. We're going to use it to fund our IBC policy or our vault. Okay. The cash that accumulates inside of our vault, we use that to invest in whatever we want. And just like you do right now, the cash flow from that investment is going to go back into your vault, right? We're going to look at that loan scenario here in just a little bit. So you pay back your vault. And then because of the arbitrage, you have additional cash flow. You have money left over and it's going to go into your bank account. But guess what? Now you have too much money in your bank. You need to put more money into your policy so you can do more investing and rinse and repeat this cycle over and over and over again. So Robert Kiyosaki talks about the velocity of money. I like to call this the flow and grow, where we are consistently moving our money and allowing it to earn compounded interest on a regular basis. Because if there's a day that we don't earn interest, that is the day that we lost money, period. Right. And I know you guys are aware of that, especially in this interest and the inflation environment. Now, all of this to say, I'm sure you guys can tell, yes, there is some subliminal messaging here. That is what we do. That is what Infinity Investment Strategies does, is we are not just going to set up an IBC policy and slap your butt, send you on your way. That's not how this works. We actually help our clients set up these policies, but put in place these cash flow scenarios and understand, hey, how does this plug into, how can I use this to invest in real estate? How can I use this to funnel my payroll? How can I use this to create cash flow? Whatever it is, we create these cash flow systems for our clients on a regular basis. And that's why we are wealth strategists. We don't just set up IBC policies and go on our way. So when we look at this and we see the vault, we see these characteristics: safety, liquidity, guaranteed growth, tax-free, and private. The only asset, the only financial asset class that checks off every single one of these boxes, that is why we're using these whole life policies that are issued specifically by A-rated, mutually owned companies. These are key pieces here, all right? So A-rated, couple of things on that. Number one, A-rated, in order to get this rating, these companies have to have a minimum of 100% liquidity for anything they guarantee. Okay, so if you see in your account, oh, I have $200,000, guess what? They are able to 100% pay that out. They have your cash on hand ready to be paid out. Even if every single client, every single customer were to cash out their account, they would have the liquidity on hand to be able to do that because they have this A+ rating, 100% reserves. Now, mutually owned, we're going to circle back to that here in a minute. Now, on the guaranteed element, again, we're using these policies because they're the only ones that have these guarantees built in. The first thing is going to be your death benefit. Obviously, we're using a life insurance policy. The death benefit, that's just part of it. We have some people who want a little, there's some people who want a lot. Again, that's not the whole point of this conversation. It's just an added benefit. So you get to pick and choose that, and it's going to regularly increase over time, but it is guaranteed to never go backwards. You cannot lose your death benefit. Even if you spend 100% of your cash, it's still there. Now, I see a lot of, young, beautiful people on this call. One of the big things that we emphasize is that these premiums, whatever you're paying for your policy, this is locked in. This is the only type of policy that your premiums cannot increase regardless of how old or unhealthy you get or how poor the performance of the company is. Okay, it is guaranteed to remain level. Now, the last piece of this is the cash value. So for those of you, you might be familiar with the compound interest curve. We go into a little bit more detail on that on meeting 2, but the whole idea behind compound interest is that it starts off kind of slow and takes off exponentially on the back end. This cash value is doing the same thing, okay? So when we see this compounded guaranteed growth and it exponentially takes off over time, that's where we start to see it, again, help us create cash flow, and we can utilize it in other areas. So the one part about this that you guys can all see on the right-hand side that's non-guaranteed are the future annual dividends. So future, obviously, this just means we cannot guarantee these companies will pay dividends in the future. But when they do, and you receive a dividend, it goes back into your cash value and it helps it grow even faster. Now, can you use that too? Absolutely, right? You can borrow against it and put it to work, all of that good stuff. But the thing to remember about these companies, let's come back to this A+ rating and mutually owned. Number one, the companies David and I use have been around since 1848, 1879, right? A very long time. And every single year since inception, they have paid a dividend. So y'all, I just kind of want to let that sink in for a second, because just imagine and think through all of the economic cycles that we have seen, or not we, that they have been able to see and experience and remain profitable to pay dividends for over 150 years straight. That's a big deal. This is really what we call the silent giant of our economy. You have banks, you have investment firms. Both of those have been bailed out multiple times. But the last one are these mutually owned insurance companies that have never received a single dollar of bailout money. All right. So again, are these dividends in the future guaranteed? No. Have they paid them for 150 years straight? Yes. Take that however you want. All right. And lastly, we are using mutually owned companies because there is no 8-figure CEO and we don't have stockholders to compete with. Because think about it. If they have stockholders and there's a dividend that gets paid, who do you think they'd rather pay the dividend to? The policy people or the people who hold their stock? The people that hold their stock. So we do not do any publicly traded companies. It's all mutually owned. Now, what I want you guys to realize is each piece of this is customizable. So when I said that David and I tailor these, we will literally move each individual piece of this specific to the person and what they're trying to accomplish. Okay. So again, we'll get more into the design, getting the cash and all that in meeting 2, and customizing it as we, as people decide that they want to set up a one-on-one, great. But this is just a high level overview of how these policies work internally. So let's move on to the actual strategy piece. There's what we call the 4 pillars of infinite banking. 4 things that when we use infinite banking in our lives, 4 things that we'll actually see happen and, help us benefit financially from these types of strategies. First one is going to be lower taxes, right? Everybody loves that. Now, like David mentioned, I come from the pension retirement planning world. So this is an area that's near and dear to my heart. And I say that because so many people are laser focused on putting as much as they can into their 401ks or pre-tax accounts. And they end up paying more taxes in retirement than they ever did while they were working. That is not an efficient strategy. What we need to look at is how can we lower our tax liability today while also creating a healthy tax environment for ourselves later on as well. We have to do yes and. The second thing is going to be increased leverage, right? So that's a business owner and investor's favorite word is leverage. So we'll show you guys how do these actually help us increase our leverage as investors, but also help increase the leverage that we have on our returns. Number 3 is increased control. So this is okay. It's all right to admit all of us here have control issues, right? We do. That's part of it. You are in a safe space. You're in good company. So the idea of this infinite banking is I want to take back control of my money, put it where I want, when I want, because I want to. And it's really nobody else's stinking business. It's really not your business. It's my money. I'm going to do what I want. So that we'll look at how IBC helps us do that. And then lastly is this lower risk. Now, this is an interesting caveat because I love real estate. I love business. I've been doing this for a long time, but I will tell you guys, as great and as awesome as real estate and business ownership is, they're not silver bullets, right? Like there's always that, we are always susceptible to market volatility to some degree. So if we can offset that and help lower and hedge our risks so that we can create protection for ourselves and our assets, and it's not just the market, there's other wealth eroding factors we'll talk about, but putting ourselves in a position of power. Everybody knows that millionaires are made in the recession. Well, those millionaires were not, they were prepared and they were ready to strike when that opportunity presented itself. So we'll take a look at that here in a minute. So let's talk about taxes. I don't know if anybody here uses a self-directed IRA to invest in real estate or for their, personal savings, whatever that might be. And again, there's no good or bad tool, but these are some problems or hurdles that we have had our clients bring to our attention when they've invested with IRAs. These are just some things that they really weren't happy with. So we'll compare what that looks like to using an IBC policy to see what the difference is. So if you invest with an IRA, the first thing to note is you do not get to take any depreciation. So any cost segregation or bonus depreciation that you get from your real estate or even from your business investments, you cannot depreciate that to offset your income, which blows my mind because one of the biggest reasons to invest in real estate is depreciation. So anyway, we're not going to go down that rabbit hole. Number 2 is deferred taxes. So again, I mentioned this earlier. If we defer, we just kick that can down the road. We are setting ourselves up to pay a massive tax liability later on down the road. We also are setting ourselves up to have 100% taxable retirement income. So retirement, whatever that means to you, that's a really weird word because I don't know that I'll ever retire. But when we get to that point where we want to take money out, the IRAs are going to put us in a position to tax at whatever future tax rates are, which I don't know about you guys. I don't think tax rates are going down, right? Lastly, IRAs are subject to UBIT. This is always fun. This is called unrelated business income tax. The shortest way to put this is if you make too much money outside of your IRA, there is an additional tax that goes against your account and lowers your returns. Kind of a catch-22. And then lastly is generational taxation. Anything that is left behind when you pass it on to your spouse, to the next generation, whatever, they will pay taxes on all of that all of the dollars that are inherited. Okay. So how do we solve those problems? Well, when we invest with IBC, again, depreciation is huge. Investing with IBC gives you the ability to 100% take advantage of any and all depreciation that's available. That's a big deal. So you get to lower your tax liability today by taking advantage of depreciation deductions. Number 2 is tax-free loans. So we just looked at how your money is continuing to grow and compound. Guess what? You get to use that money. You can use that money the entire time that it is growing and compounding completely tax-free through the loan strategy that we're going to look at here shortly. Okay. So all of that money is tax-free. And then when you get to a point where you're ready to sit back on the beach and sip margaritas or whatever your drink is, right? You have another tax-free source of income. So most of us here, we are saving, we are investing, we're doing as much as we can to create multiple streams of income, cash flowing assets, right? I'm probably in good company here. So these policies are no different. This is just one more cash flow arrow in your quiver, right? When you get ready to flip the switch and, hey, I don't want to put money in, I just want to sit back and collect a check. Great. Boom. It's a tax-free guaranteed income stream for the rest of your life, just like our grandparents used to have with the pensions. Okay. There's absolutely no UBIT. In fact, there's no tax filing at all because guess what? It's not the IRS's business. This is completely shielded. And then lastly, you have a tax-free transfer of wealth. So when we graduate from this world, everything that we leave behind is completely tax-free to the next generation. This is such a big deal, y'all. I mean, I want to hone, there's no estate, no inheritance, no income tax, nothing. This is such a big deal. They actually wrote a book about it called What Would the Rockefellers Do? So if you want to ask somebody about generational wealth, the Rockefellers probably have it figured out pretty well. So we'll move on. Let's talk about increased control. And I'll tell you the number of times that David and I have talked with people, they're like, you know what, this sounds great, but how do I actually get my money? Like, how does this actually work? So we're going to hone in on that. When your cash value is what you have access to. And when you are ready, here we go. When you are ready to access your cash, you can do so as a loan or as a withdrawal. Okay. 99% of the time when we're doing this through infinite banking, we're going to take it out as a loan. All right. Yes, we're going to look at that strategy. I keep saying it. I promise it's coming. We're going to take it out as a loan. Now, either way, it doesn't matter. When you go to access your money and you call them and say, hey, send me some money, they do not ask any questions. No question. Well, let me say this. They ask 2 questions. They want to know, how much do you want and where do you want it sent? That's it. There's no, what do you need the money for? I mean, David and I both talked about this. Y'all try to go to your bank and take out more than $10,000 and see how easy that is. And how many questions, you got to have like the eye of a bat and blood of a gargoyle or whatever. Here's the thing. This is just a quick, easy transfer. Also, your cash value is 100% accessible. There are no vesting periods. There is not a surrender charge. Whatever your cash value amount is, that is what you can get to. All right. We don't play games with any of those surrender values or any of that. Yes, those policies exist. David and I don't do that. Okay. 100% access to your cash value. Now, here's the cool thing. These loans are done on your terms. What does that mean? Well, the insurance company, there is a simple annualized interest rate that is attached to these policies, but the company's going to set that simple annualized interest rate. Everything else, you actually have the ability to dictate that on your own. So for example, you get to pay that back at what pace, when you want, and how you want. We had a client that was doing a new development. He was building out a new neighborhood. And he planned on the project taking about 12 to 18 months. Well, in true construction fashion, it took almost 3 years. 3 years, y'all, for that project to be completed. He was not getting ugly calls from me or David or letters or penalties or any of that. He did not make a single loan payment the entire 3 years. When his project finished up and he got the capital, he paid off the loan all at once, and then he used the money again and he rinsed and repeated the process. So, and I'll tell you, I had the exact same thing happen in a single family investment, development investment that I did. We started the first one February of 2020 and the second one March of 2020. So all of you guys can imagine the headache that was. But again, mine was only supposed to take 4 to 6 months, and it took over a year. But I was not subject to have to pay this loan back. I was able to leverage that and not have to worry about it until my deal closed out. We saw this happen in 2020. People who invested in multifamily and they weren't sure if rents were gonna come in because of the eviction moratorium. Guess what? There were a lot of passives who were not getting any cash flow from their properties. Everything stopped for a while. Well, if you're not getting cash flow, how are you going to pay your loan back? You don't have to, right? You're not going to get penalized or any of that. There's just a simple annualized interest rate that goes on each year. That's it. So yes, we'll take a look at that loan here in a minute. Now the savings. Oh, the question is, well, how much does this cost? Well, let me ask you, how much does a house cost? Right? You can buy a $300,000 home. You can buy a $300 million home. It doesn't matter. Each person, again, this comes to the customization. You get to choose how much you want to put into this. It doesn't matter. All right. The strategy stays the same. Everybody has a different number of zeros. It doesn't really matter. All right. Now, how this works is, remember, I said that base premium is locked in. It cannot go up. You get to pick whatever your minimum is. We've done people, right? We've had policies that are $10,000 a year, and we have policies that are 6 figures a year on their premium. Again, everyone's different. You get to pick that minimum that you do every single year based on your comfort level. Now, think about your house payment. You know what your mortgage is, right? But can you pay over and above your mortgage to build up your equity faster? But do you have to do that? No. So the same thing here, you know what your base premium is going to be, but you have the ability to put additional cash. PUA stands for paid up additions, additional cash into your policy, and that goes straight to your cash value. Okay, so the difference is this happens much faster than a mortgage amortization schedule, I promise. So you get to pick whatever your minimum is, but all of the dollars that you put over and above, that automatically is going to funnel into your cash immediately. Now, I will say what you will see is whether you're doing your base or you're doing these PUAs, either way, you're going to see that your cash value is increasing every single year. Now we'll talk on the savings and how we distribute that and how we overfund and all that. That's more of a meeting too. David will go through that in a little bit more detail, but just know there's a minimum and a maximum, and you can go anywhere in between that. All right. Now the reliable projections piece, again, this is just, I want to harp on this. This is a guaranteed growth asset, regardless of what the market's doing. So I don't know what y'all's experience is in the financial world, but you don't see this word very often. You just don't, right? So they have guaranteed growth with dividends attached. And again, the dividends aren't guaranteed, but they've paid them for over 150 years straight, never missed a year. And I'm a natural skeptic. So before, this was years ago, but before I ever put money with this, I'm looking at it and I'm like, you know what? How do I know that they're actually going to do and pay what they say they're going to do and pay? So I personally pulled the dividend history of these companies. I said, okay, well, let's look at what they projected versus what they actually paid. Over the last 50 to 60 years, they have either met or exceeded their projected dividends every single year, except for 2 years. And the 2 years they missed it by 0.5%. So the point of that is, as we start to build these out and we show people what these policies look like, we're not just throwing stuff at the wall to see what sticks, folks. This is real numbers. This is your banking ledger that you can plan what your business is going to look like over the next 5, 10, 30, however many years in the future. And you know that it will be that or better. Okay. So let's talk about the risk and then we'll move on to the loan strategy. Of course, everybody always thinks of the market, right? Especially in this crazy economic time. This is the only uncorrelated asset, zero correlation to the stock market whatsoever. What does that mean? Well, guess what? If the market goes up, your IBC policy goes up. If the stock market goes down, guess what? Your IBC policy still goes up. This is true diversification, folks. All right. Now, when we look at this, one of the interesting concepts is Well, most of the time, real estate and business opportunities present themselves whenever the market is down, when it's crashing, right? If our liquidity is tied to the market, how are we going to take advantage of those opportunities and lock in our losses? That doesn't make sense, right? We need to be able to take advantage of those opportunities when they present themselves. Now, creditors in the IRS, if you have a financial hardship, if you have a tax lien, if you, God forbid, make an accounting mistake, or you have somebody coming after you, they can come after your house, your car, your bank account. They can seize your dog for all you care. They cannot touch the cash, your IBC policy, your life insurance policy cannot be touched. Now, this is a state by state basis. So here in the great state of Texas, these policies are 100% protected. They cannot touch a dollar. The lowest coverage, the lowest protection goes all the way down, and it's in California, is down to 50%. Lauren's like, yeah, of course it's California. But the point is, anywhere between 50 and 100%, this is a state by state basis. We can talk with you one-on-one and kind of see what that looks like. But the point is, the IRS and your lenders cannot seize that if you have some sort of financial hardship. Now, if there's a run on the banks, again, we've seen situations like this in Canada and in Europe. I'm not talking like in the 20s. I'm talking like within the last couple of years. Banks have zero reserves, folks. March of 2020, they lowered major bank reserve requirements down to zero. They do not have your money. It is gone. And what happens when the market is kind of finicky? Well, that's when they're going to be tightening up on credit expansion. That's when they're least likely to lend. We have a guy that is in North Carolina. He owns 120 units outright, owns the apartment complex. He had over $1 million in equity in his primary residence. He needed that money to funnel into his apartment. Obviously, during 2020, it was chaotic. He needed that money. He went to the bank and they told him no. Wouldn't do it. Because do we really have ownership over something if we have to ask somebody else permission for it? Probably not. And then the last one is predators. We're in a sue happy world, right? That's just, it is what it is. We are in a sue happy world. This could be a disgruntled investor. This could be a clumsy tenant. This could be somebody breaking the bad boy rule. This could be a car wreck. It could be something completely outside of business. David and I have both had to, in the last couple of years, deal with people in our family getting in an at-fault accident. So if that person decides their neck hurts a little bit too much, they can come after you, your house, your car, whatever. But again, these policies are protected. It's not just the stock market. It's all of these other wealth eroding factors that we need to consider and protect our assets against. So again, that's why Warren Buffett calls this the vault. All right, let's talk about the good stuff because I know y'all want to know. Let's talk about leveraging ourselves and leveraging our assets. So the first thing is, with these policies, let's talk about financial reporting. If you are trying to present yourself to a lender, whether you want to go, or if you're trying to show yourself as an accredited investor, and you want to show net worth and liquidity, you get to use 100% of the cash value inside of your IBC to increase your net worth and your liquidity. This is a big deal. Lenders love to see it. They know that it's protected. They know that it's accessible, and they know that it's uncorrelated to the market. They will give you 100% credit to increase your net worth and your liquidity. You can, now, if you collateralize it with the bank, that's up to you. But again, you get to use this cash value as part of your net worth. That's a big deal. Now, again, your vault, you can open the door and show the cash when you want to, but let's say you want to shield your assets. So I have two young girls, they're 7 and 13, and please pray for me. But let's say in the future, they decide to go to college and they're applying for, FAFSA scholarship, anything like that. If I have a 401k or a 529 or my bank account, they will use all of that against me to hurt them for them being able to qualify for any sort of financial assistance or scholarships or anything like that. You know what I don't have to disclose on any of those applications? You guessed right, my IBC policy. It is none of their business. I do not have to disclose a single dollar to them on that. Let's say that my girls don't even want to go to college. My oldest is talking about wanting to start her own business. Well, guess what? If I have a 529 plan and I use that for anything other than college, I get penalized. My IBC policy, what are the two questions they're going to ask? How much do you want and where do you want it sent? That's it. So I can use it for whatever I want, and I can shield it from being harmful to her for actually qualifying for these different situations, things like that. Now, let's go all the way back to the very first thing that we talked about, which is how banks make money. They're creating arbitrage, right? I paid you guys 0.02% and I loaned it out to David at 6. I created arbitrage. So when we're doing that within our own IBC policy, the number one thing that we need to remember is that we're using companies that have non-recognized loans. So this goes twofold. Non-recognized means that it does not hurt your debt ratio. So these loans are not reported. It does not show up on your credit. It does not hurt you if you're applying for a loan elsewhere. On the other end, non-recognized means that they are going to continue to pay you dividends and interest on your money, even if it's loaned out. That's where we get the dual rates of return. That allows you to earn continuous compounded interest indefinitely. You're going to earn compounded interest on those dollars, regardless of what you're doing with them. So the big thing to remember, again, the very first thing we talked about is there is a difference between the spread between interest rates and the IRR. There's a big difference. We need to have that mind shift between money and math. So let's look at an example. Let's say that you have like an IRA or a regular withdrawal account like a bank. If you have $100,000 in there and you want to take out 70 for whatever investment, you're only going to earn interest on the 30,000 that's left over. That's just a typical scenario. That's how it works. Now, let's say that you have become your own banker. You still have that $100,000 in there, but this time you're going to take out that 70 as a loan. You're going to borrow against your cash. And yes, again, there is a simple interest rate attached to that loan, but you can go and invest in whatever you want. It can be single family. It can be multifamily. It can be your little business. You can invest. I mean, I've had people buy trucks with it before for their company. Doesn't matter. Use it for whatever you want. Go blow it in Vegas for all we care. Don't do that. But the point is you can use your money for whatever you want. Now, right now, I want you guys to think through it. When you get any sort of income or cash flow, whether it be from a real estate investment or a business, where does that money go right now when you get it? It goes to your bank account, right? You put it into your bank account so you can turn around and use it again. The exact same situation applies here. Any cash flow that you get from those investments, instead of putting it into your traditional bank, it goes into your IBC account. So you can turn around and use it again. The difference is that while your money is out here earning a rate of return, because remember, all of these things, these are your investments. That's where you're getting your rate of return. Not one time will you hear me and David talk about IBC being the best rate of return ever. Is it good and is there benefits to it? Yes, but it is not our accumulation tool. This is just a warehouse of wealth. So the entire time your money's been out there getting your rate of return, you've been earning interest on the full 100,000 at the same time. So you're able to get dual rates of return on a protected asset that's growing tax-free. So how does that work? Well, I'm not going to go into that just for the sake of time. Again, money and math are very, very different. So I'm showing you guys this scenario right here. And what we are assuming is that the interest rates are equal. We're going to earn 5 and pay 5. This is not real numbers. David will give you a real example in meeting 2. This is just to help have that mind shift to understand the difference between money and math. So let's pretend that you have $100,000 that you're earning 5% compounded over 5 years. Okay. You also, at the same time, take out a $100,000 loan that you pay 5% simple on for 5 years. Most people look at this and think, oh, well, I'm paying 5 and I'm earning 5. So that should come out to be a wash, right? No, let's look at this. In this example, on $100,000 over 5 years at 5%, the interest total based on this payment schedule would be about $15,000. And I'll tell y'all, I know some people are like, what? Are you crazy? Why would I pay $15,000 in interest when I have the cash sitting right there? This is dumb. I'm out. Wait a minute. Let's think about this. We paid a simple interest over 5 years. But what's also been happening over the last 5 years? Even though we had this simple interest loan, we've been earning compounded on those same dollars. Even if this policy only earned 5%, which spoiler alert, it's a lot more than that. Even if it only earned 5%, over 5 years, this $100,000 has managed to compound almost $28,000, $27,628. So yeah, I'm going to be like the bank. Remember, I paid 2.02% to earn 6. I'm going to pay a little bit here to go earn a lot. we are recreating that same arbitrage system that the banks are allowing us to do. So again, if we look at this, we think, oh, I'm earning 5 and I'm paying 5, that comes out to a 0. No, that's the spread. Don't get tricked, right? So we're going to talk about financial truths. So again, the big thing to understand is these policies are continually earning compounded while we're paying down simple. Now, I will say a lot of people look at this and they think, oh, 5% simple. Well, how does that compare to like a bank loan? I'm so glad you asked. Great question. The way that banks structure their loans is very different. In fact, this slide that I had back here talks about even with these crazy low interest rates, because banks use amortization, that means they front load all of the interest to the very beginning of the loan. Even with a 3.5% and a 2.7% interest rate, anywhere between 50 and 60% of every dollar we pay goes to interest. So when we compare that to a simple, well, and I know this is really small, but just so you know, if we wanted to see what a bank loan would look like compared to a simple interest loan, a simple interest loan at 5% on $100,000 over 5 years is equivalent to a $100,000 loan at a bank over 5 years at 3.81. So again, there's a difference between money and math, and it's not about the interest rate. Again, this rate looks a lot better. I'm sorry, this rate looks a lot better, but it's about the volume. Remember how I said the volume of interest is what is important. So again, because this is just a flat rate for the year, they're not going to front load that. So this is the last part I'm going to talk about. I want to open it up for Q&A, but I'll tell you, we get the question all the time. You know what, Erica, David, this sounds great and wonderful and all that, but if this is so great, why isn't everybody doing it? Well, who's your everybody, right? Are we going down to 7-Eleven? We're going to get a Slurpee and talk to our Edward Jones guy while we're there because they're both on every corner. We're going to ask them what to do. Or are we asking the guy down the street that has a subscription to Forbes magazine, right? No, we need to look at who are the people that are using this and who are the people that are successful that we want to emulate what they're doing. So a couple of examples here. I don't know if you guys know what this is. This is Rockefeller Center in New York City. This is, fun fact, the largest privately funded construction project ever built. So back, Great Depression hit, J.D. Rockefeller wanted to build this monstrosity and the banks wouldn't give them a loan because it's a Great Depression. They don't have anything. So J.D. Rockefeller fully funded the entire construction of this building with his own personal cash value life policy. And he could do that because it wasn't correlated to the market and he had 100% access to it. Same thing happened to Walt Disney. He had a movie production company, but he wanted to start a theme park. So the bank, he went to him and he said, hey, I want this loan. The bank told him no. Can you imagine being the banker that told Walt Disney no to start Disney World? Like, doink. Anyway, they told him no. So he used the first money ever put into the Disney World theme park was his personal cash value life money. There was a lady, a home ec teacher in the 80s. She was a home ec teacher. She wanted to start a good cookware company. The bank, again, go figure, bank told her no. She used $5,000 from her personal cash value life policy to start Pampered Chef. She sold that to Berkshire Hathaway in 2016 for $1.8 billion. So yeah, that's a pretty good rate of return. We have a family out in California, Foster Farms. They are one of the largest chicken producers in the entire US. They've been using their own personal cash value life policy for a really long time. We've got these guys. We have politicians all over the place that have used these policies to fund their campaigns and their personal investments. Joe Biden, John McCain, Donald Trump, the Kennedys, the Roosevelts, all of these guys. So a couple of things. Number one, my joke is if Republicans and Democrats can agree on something, it's got to be pretty good, right? Like, obviously there's something there. But also, a lot of people always ask us, like, well, what if the rules change? What if the laws change? Great question. Number one, they're always grandfathered in. They can't, this is a unilateral contract. They cannot go back and change your policy. But also, don't you think that the people writing the laws are going to protect where they save their money and continue to maintain the tax benefits? I mean, they've done so for the past 150 years, so they'll probably continue to do so. The last thing I would point out is if you guys get a chance, look up BOLI-COLI if you can. This stands for bank-owned and corporate-owned life insurance. The largest banks and the largest corporations in the world hold a majority of their assets inside of these types of policies. Bank of America and Wells Fargo both hold over 50% of the cash on their balance sheet inside of a BOLI. So yeah, It's interesting. So JCPenney is kind of our poster child because we talk about all the fun and good things, but what happens when it hits the fan, y'all? When things go wrong, not if, but when things go wrong. So again, JCPenney, Great Depression hits, they can't afford anything. They're a retail store. So they actually took a loan against their corporate-owned life insurance policy, and they used that to pay every single JCPenney employee throughout the entire Great Depression. And they knew that they could do that, again, not tied to the market. They had access to it, but they knew they would not have to pay. They didn't have to pay that loan back until they were ready. So they could leverage that storm, allow sales to pick back up, generate revenue, and then they paid it back whenever they were getting ready. So again, these are just some prime examples of different ways that that these policies, and it's not about the policy, it's about the strategy, you guys, right? We're not, David and I really couldn't care less. We're not, product pushers or anything like that, but this strategy overall has been used for over 100 years in so many different ways. So it's just really unique in the way that you do it for yourself. But that's really the end of it. We'll open it up for questions. Again, David is going to go through in meeting 2. He's actually going to go through, okay, well, now we understand how these policies work and what the strategy is. How do we get this thing funded so that I can use cash tomorrow? Michelle, good question. I will, if you will shoot me an email, I have some resources. I've got a good little ebook that is, Kim Butler does a great job. It's called Live Your Life Insurance. It is a very high level overview for infinite banking. She does a great introductory, it's like 50, 60 pages. It's pretty quick and easy.
Cool.
And so my email, just so y'all know, I'll put it in the chat. Erica Infinity. Perfect. Jeff, why is it considered arbitrage if you're paying simple interest to yourself in addition to earning? Great question. So that is we see this all the time, and we really want to make sure we clear this up. The interest, that simple interest that you're paying, is not going back to you. So that's different than like a 401k or anything like that. That simple interest that you're paying actually does go to the insurance company. That's actually another source of revenue for them. So think about it like a 401k. You could pay that interest to yourself, but if you had 100 and you loaned out 70, you'd only be earning interest at the 30. But if you're paying interest to yourself, you could do that. But because, right, you're actually paying that interest elsewhere, think about it like what they do on commodities, right? So they're going to buy some here, turn around and flip it there. They're taking advantage of that interest. So that interest you're paying is going to the insurance company, and you're maintaining. Let me see. Is this IBC similar to Universal Life? Good question, TJ. I'm so glad you brought that up. David and I, again, we are authorized infinite banking practitioners. We have the license, we have the certification. We also have the regulatory authority. They monitor what we do, and they actually keep an eye on that. Infinite banking Universal Life is not the tool designed to do infinite banking, especially over the long term. The big reason behind that is Universal Life has what's called a target cost of insurance. As you get older, as you get less healthy, and if the company's performance on their internal investments does not perform the way that they hoped, they can actually increase what you have to put in. And I've actually had clients that have had policies for 10, 15, 20 years, and they're like, hey, I'm going to just start taking money out, and I just want a cash flow. And the company says, oh, wait, no, you can't take money out. In fact, we need you to put money in, or this thing is going to implode. They become what we call carnivorous, because you have a fluctuating cost of insurance, a fluctuating cash value, and if you're trying to take money out, they can implode. So we do not use Universal Life for infinite banking. Again, there's no good or bad tool. Those tools are more on like maybe on like a key man side, or if they're going to be doing some short-term transactions for like 10 years or less. Good question. Any other questions that you guys can think of? All right, excellent questions. So again, we are going to be, hosting IBC number 2, and that's where we're going to actually talk about the policy design, the funding, how do we get cash in, how do we decide how much to put to base and the PUAs and the minimum and maximum and IRS and the real estate example, all of that fun stuff. So we will be doing that. David and I are going to collaborate on timing, and it will obviously be after the 4th of July, but we're probably going to shoot for this middle of the day. If you guys have feedback, we're 100% open to that. I put my email in the chat, so feel free to shoot me an email and be like, hey, Erica, you know, let's maybe adjust that. Or if you prefer a different time, great. Of course, feel free to invite your friends, share this video with them. I highly recommend if they want to come to meeting 2, great, but they really need to watch the intro first, because as you guys know, it's kind of like drinking from a fire hydrant, right? Like it's a lot. Other than that, I want to make sure we finish on time, be respectful for you guys. If you would like to set up a one-on-one, our website is infinityinvestmentstrategies.com. Again, I'll put that in the chat. Or you can email me and I'll send you a link to our calendar. And that way we can schedule a one-on-one and answer any questions or move into some more tailoring aspect for you if you'd like. Infinity Investment Strategy. It's long, but it's all spelled correctly. Awesome. Thank you. Mary, I'm glad you made it. Yes, I'll let you know when the next webinar is. Also, we are on social media, Infinity Investment Strategies. So if you want to follow us on social media, we'll post the links and all the updates on there as well. Thanks, Lauren. Glad you liked it. You guys have a great rest of the day. Happy 4th. Happy birthday, America. You guys have a good one.